So, TFSAs and RRSPs. What are they and how do they work? There's a lot of confusion as to the differences between them and how to use them effectively. This video is a brief introduction for what you need to know to make the right decisions. Some people think of an RRSP or a TFSA as a type of investment. TFSAs and RRSPs aren't specific investments. Instead, they're a way for you to shelter your investments. You can hold many different kinds of investments under this shelter. GICs, mutual funds, stocks and bonds, or even a high-interest cash account. By sheltering your investments, you protect yourself from paying high levels of investment income tax. If you don't shelter these investments, you'll pay tax on your investment income, and this triggers a negative effect on your real or actual rate of return. For example, let's say you made $10,000 in an open or non-registered account outside of a TFSA or RRSP. Because this investment income isn't sheltered, you actually made significantly less than $10,000. Depending on the type of investment income earned, your real return would look more like this. So TFSAs and RRSPs are similar in the way they protect your investments from tax and what you can invest in them. However, they're different in terms of how you contribute and withdraw from them. When you contribute money to an RRSP, you reduce your taxable income for the year. This means you're going to either pay less tax or, even better, get a tax refund. Did you forget to make an RRSP contribution last year? Well, not a problem. You have until 60 days into the new year to make a contribution for the previous year. So that all sounds good, right? Why not just contribute all your money to an RRSP and not pay any tax? Unfortunately, there is a maximum amount you can contribute, called your contribution room. This is calculated by multiplying your taxable income for the previous year by 18%. There are also dollar maximums, and this amount will be reduced in cases where you're a member of a pension plan. If you haven't used all your room, that's not a problem. It accumulates and you can use it later. You can find out how much room you have by calling Canada Revenue Agency or looking at the bottom of last year's Notice of Assessment. The big thing to remember is that when you withdraw money from your RRSP, it's added to the rest of your income and the full amount is taxed. Exactly the opposite of when you contributed it. The best way to maximize the use of an RRSP is to contribute to it when you're in a higher tax bracket than when you withdraw from it. There is one useful exception. If you're a first-time homebuyer, you may withdraw up to $25,000 from your RRSP tax-free, as long as you pay it back in 15 equal installments over 15 years. Also note that RRSPs must be cashed in or converted to income by December 31st in the year that you turn 71. Now that you understand how RRSPs work, let's look at TFSAs, as they are slightly different. With a TFSA, you don't get a tax deduction for contributing to it, but you also don't get taxed for withdrawing from it. All it does is shelter your money. Just like an RRSP, there are contribution limits, but they're fixed for everyone. The total that you can hold in your TFSA for 2014 is $31,000, but the limit does increase by $5,500 per year. The last major difference is that in an RRSP, you can only use your contribution room once. But with a TFSA, you can withdraw money and re-contribute it again as long as it isn't in the same calendar year. RRSPs and TFSAs can be very powerful tools, but like any other financial tool, they need to be used correctly. By working with a financial planner, you can use them to your full advantage. Are your RRSPs working for you? Contact Millstone Financial for a free consultation.